key important sentiment or economic indicators there's one can always look at or even assess, especially when you look into the US economy. True enough, you look at some of the key important economic indicators, it does point to certain impact of sluggishness. It does reflect to a certain extent where the US economy is going to hit going forward, and it does create a lot of tension, especially for government policies, whether can we continue to see monetary easing going forward, and that will create a lot of shockwave into the markets. So if you are trading in the futures market, you just have to embrace that kind of volatility as we head into very volatile periods in coming months. I just want to share with you certain key aspects to look at, and do track these indicators quite closely, because it does give you a picture. It does rather paint pretty much whether the economy is going to go into a recession period or whether the economy do show sign of growth. But where we are standing now, where we are heading now, it doesn't show that's the case. So I think really, these indicators do track it closely as we head over to the next few quarters. Whether are we going to be really going into a period where we're going to see sluggishness in some of these indicators. I think as a trader, we always want to be quick in the market. So having a proper technical setups is actually quite convenient in the sense that you can time your entry and exit through chart readings. So I'll be sharing some very simple technical setups that you can use, especially when I'm trading the US indices. And I think mainly we'll be touching on the micro contracts, and mainly focusing on the Dow and as well as S&P 500. And I always believe that in every trading plan, it's important for you to establish a proper risk management tool. And as I mentioned just at the beginning of the webinar, stop loss is important and imperative during this critical time. As we enter into very volatile period in the markets, stop loss measure is equally very important whenever you place your position, whenever you enter positions in the market. So I'm just going to give you a very brief background on where the economy stands. I think if we just look at US numbers itself, they're all quite rosy, painting quite rosy picture, especially in the beginning of 2021. But as we enter into 2022, things start to change. If we just look at first quarter, it looks like economy does show you some strength, but as inflation starts to pick up, as commodity prices starts to hit higher and higher, and that's where concerns are growing. So if you just look at recent estimates, even by IMF projections or even by World Bank, they are forecasting that not only in US but pretty much around the world, we are looking at slower growth going into the next few quarters. Now, this exacerbated by Ukraine and Russia conflict, and also with supply chain issue that's surrounding a lot of key major commodities. So really, I think going forward, growth doesn't seem to be very rosy, especially we hit into second and third quarter, and that's where we really need to be careful. So if we are going to the market, in mind that this year is going to be having a better performance compared to last year, I think that's going to be a foregone conclusion. I think what is important is that as we hit into second and third quarter, where market is expecting that things is going to get a bit more sluggish, and that's where we really need to be careful. And just be aware what government, especially what Federal Reserve policy is, whether they continue to be tightening their measures, especially reining in inflation. So that's going to be a concern going forward. Now, GDP is a very key barometer whenever you gauge the economic performance. If you just look at US GDP numbers, quarterly basis, I think US has just recorded the first negative quarter since the start of the COVID-19 pandemic. So that's quite shocking. Now, if you dive deep down in the numbers, it will tell you a different story. But what's important is that general measures shows that GDP might hit on a declining phase. And that's important because if GDP numbers are not growing, that shows you that the economy is actually quite stagnant. So that's where a lot of the buzzwords of stagflation has been looming. So I think that's where we really need to be concerned, be giving a bit more attention to. So really, I think going forward, GDP numbers are worth to watch. And as GDP numbers are not growing and we have very high inflation that we are currently in, and that's where really the risk of stagflation is going to be quite imminent. So if we just look at the recent GDP numbers, if you just dive deep down in the numbers, although US did record a negative GDP in terms quarterly, the numbers is actually telling you a very different story. So the negative numbers are actually mainly attributed to the inventories as well as the net export and import. Given the fact that US dollar has actually strengthened a lot recently, a lot of people are expecting that interest rates in US is actually going to hike on a higher cycle, so therefore causing a lot of imports pressure, import pressure. So generally the net exports has actually been on the negative side. But if just look into consumer spending, or rather, domestic capital expenditure, which is another component of GDP, those numbers actually, in fact, is growing. Keep in mind, US economy is very reliant on consumer spending. Pretty much about 60 to 70% of their total economy is actually based on consumer spending. So as long as consumer spending show healthy sign of growth, there's no risk. Pretty much there's no general risk to the economy. Now, if consumer spending starts to deteriorate or the acceleration starts to decline, I think that's where we really need to pay close attention to. Right now, the numbers are still quite supportive, but really, going to the next second and third quarter, given the rise in inflation, given the global economy is actually showing sign of slowing down, really consumer spending is something that you should be paying close attention to. So as long as consumer spending are showing you right now healthy, robust sign, is still quite supported, but really going to the second and third quarter, that's another factor that we should be paying close attention to. Now, if you just look at US major indices in terms of their performance, if you just look at whether it's S&P 500, the Dow Jones Index, or even the Nasdaq, three of these major US indices has actually been pointing, or in fact been trading below the 200 period EMA respectively. So it goes to show that 200 period EMA is where the market is taking as a long-term average in terms of their price performance. So it goes to show that these three major US indices is actually trading below their market averages. So it's showing you sign of weaknesses. So as long as the trend continue to stay below the 200 period EMA, it shows you that the market is not showing you any sign of strength. So as a technical trader, you'll be really paying close attention to where the market is trading respectively to its 200 period EMA, because that's the long-term average, and that's where the market is using as a gauge to see the strength of the market. So right now you see the three major US indices is actually trading below the 200 period EMA. If you continue to stay below the 200 period, it's just pointing you that the market overall doesn't show you doesn't show any sign of strength in terms of the prices. Now, when it comes to government policies, you have probably heard the news. Just overnight, Federal Reserve has just increased 50 basis points. So the overnight Fed Reserve is actually riding on 1%, and it's showing you sign that the market is going to be tightened even further in terms of financial conditions. And as Federal Reserve tighten the policy, really is going to impact in terms of equity index. We have seen historically every time when US starts to hike interest rates, equity will not be favored. In fact, there'll be a lot of outflows going out of the equity market. So clearly we are seeing that. But what's shocker is that if you just look at Fed Reserve statements by Jerome Powell yesterday night, you probably have seen that market was expecting 50 to even 75 basis points in terms of interest rate hikes, but we don't see that. And in fact, I think Jerome Powell did give the confidence in the market that they probably will limit the high interest rates to about 50 basis points going forward. So in a way, if you look at it, if you just look at the overall sentiment or how the market interprets Jerome Powell's statement, it seems to be, market is actually quite dovish with respect to the statements. So going forward, I think you won't expect a 75 or a basis point in terms of hike in interest rates, but really I think the limit will be capped at 50 basis point. And I think that's showing you that it's quite accommodative to a certain extent, and therefore I think market reacted to it. But keep in mind, equity markets are still based on economic fundamentals. If economic fundamentals warrant aggressive rate hike, eventually the rates will have to increase to adjust to economic fundamentals. And if you just look at it, I think really inflation is going to be a major theme this year. And I think that's where the Federal Reserve is putting a lot of attention to it. Now, there's always a dual mandate by Federal Reserve. One is to control the labor position in the market, and another concern is always the price inflation. So if you look at labor market, I think generally the labor market has been quite robust. Since COVID-19 pandemic, a lot of stimulus has been put into the market. Labor market conditions are actually quite accommodative. But if you look at the other mandate, the price inflation perspective, I think that's where it's going to be a major concern for Federal Reserve this year. And if a lot of market opinion or consensus is that pretty much the Federal Reserve is actually behind the curve. They should be reining in the inflation much sooner rather than later. So going forward, really, I think is how fast can Federal Reserve hike interest rates to control the inflation level, the general price increase across the market. But right now, if you just look at labor market conditions, they are still quite healthy, and I think that's showing you a sign that the Federal Reserve should be paying more attention towards controlling price inflation. Now, if you just look at yields, this is what market gauge is looking at. Market indicators is everyone is looking at. Is to basically look into the difference between the 10-year Treasury yield and the 2-year Treasury yield. So obviously, when the yield curve, a general normal yield curve will always be, you have a much lower rate on a shorter term trend as compared to longer term yields. So that's a normal healthy market. But if you have an inverted yield where shorter terms are much higher, that's usually precedes that the market is actually quite imbalanced. So if you just look at it, historically speaking, whenever you have a curve that's inverted, whereby your shorter terms are much higher compared to longer term, generally it precedes to periods of recession. If you just look at the gauge itself, it's quite predictive to such an element for the past at least three to 4 decades. So really begs the question is that right now the yields are pretty much the difference are almost touching to parity, and to a certain extent it was quite inverted in certain instances. So the biggest question is that whenever yields are inverted, will we see a recession looming in the next 6 to probably 12 months? So I think that's keeping traders on tenterhooks, really where the market is going to hit, and would this be some imminent signs where market should be paying close attention to? Again, I think as interest rates starts to rise, yield differential is something that's going to be worth paying close attention to. Now, like I mentioned, I think inflation is going to be a major theme this year for across a lot of major central banks. I think the major one will be in Europe. If you just look at Germany itself, their CPI numbers are way over the roof. So really, I think a lot of central banks across the world are battling pretty tough on trying to rein in on inflation. Because once it gets to uncontrollable levels, I think that's where it will become a bit more dangerous. It will set quite a dangerous path for policymakers. Now, with that in mind, I think there's always the looming risk of recession coming into play. So obviously, I think one major aggravation is always the price of commodities. If you just look at historically speaking, every time when you have high oil price environment, if you just look at oil prices since the early start of 1970s, whenever you see a spike in oil prices, it always precedes into economic recession. It will be probably 6 to 12 months down the road. Now, this is historically speaking. I think the reason is because when you have high oil price environment, normally you create a lot of inflationary pressure across the board. And once you have high inflation levels, normally interest rates will have to hike to rein in that kind of inflation. And generally, businesses will be affected because of the higher costs, financing costs. So I think that's where we really need to be concerned, because right now we are seeing a lot of price pressure in terms of commodity prices. It's not only oil prices. You look at grains, you look at other major commodities, they're all actually reaching all-time high. So that's really trying to tell you that commodity in general has been putting a lot of pressure to the economy. So if you just look at historically speaking, whenever we have high oil price environment, normally it precedes into a recessionary period in the economy. And if you just look at consensus or even market forecasts, really I think market generally is quite bearish this year, going to the second and third quarter. Given in mind that we have high interest rates and even we have inflationary as a concern. So in fact, market is expecting probably there's a 50% chance that probably we'll see a recessionary period as early as first half of next year. So I think with this sentiment in play, it's very difficult, for stock indices to really climb all-time high, given the fact that the economic fundamentals are not supporting it at this point in time. So again, I think commodity prices has been reaching all-time high and it's putting a lot of pressure. The thing is that it's not only the developed economies feeling the effect, even the emerging economies or even emerging markets is feeling the pinch. So really, I think it's across the board. The impact is across the board, and really, I think going forward is pretty much on how central bank is going to rein in on such a high inflationary numbers. So if you just look at US, officially we start the quantitative tightening. Balance sheet is going to start to reduce as on 1st June, and interest rates are going on is stepping up on a high cycle. So really, I think that's where we will see a lot of outflows coming out of the asset classes, especially in the equities market. So really, I think everyone is also watching closely on how Federal Reserve is actually going to reduce the balance sheet size. So obviously, if you just look at Jerome Powell's comments, he was saying that probably will starting to reduce about 40 billion a month for the first 3 months at least, and it's going to step up into 90 billion a month going forward. And that's how probably you'll reach the pre-pandemic level in terms of balance sheet, probably the early part or even the first half of next year. With all this tightening, it's for sure that a lot of outflows is going to come out from asset classes. And that's where, if you are trading the US indices market, it's worth to pay close attention to, especially when, fund flows are moving out of the equity space. So if you look at central bank's balance sheet, it starts to show declining pace. So it's a matter of whether is it going to be any pullback in terms of balance sheet, which means that will Federal Reserve be accommodative eventually, especially when economy starts to turn downside. So right now, I think we look at the labor numbers are still quite positive. Obviously, inflation is an immediate concern. But eventually, when economy starts to become sluggish, whether Federal Reserve will pull back or reverse its policy, I think that's something for us to watch out. But right now, I think pretty much not only Federal Reserve, I think a lot of major central banks across the world is also putting up, tightening their balance sheet, or in fact reversing their balance sheet to a certain extent. So rate cycle, I think is something that we have to pay close attention to, at least for the next few months. I think Federal Reserve is going to step up on a very aggressive pace. In fact, I think 50 basis point is pretty much given for the next 2 meetings. That will bring us up easily to 2% in terms of absolute rate. But a lot of market forecasts is looking at about 3 to 4% to be the neutral rate in order to adjust the inflation numbers. Now, when it comes to inflation numbers, when we look at the latest numbers by the US economy, it was registering about 8%. Some may say this could be a peak, as long as when commodity prices starts to decline, pretty much the inflation numbers will probably be the peak. And if inflation numbers starts to decline, moving forward, I think Federal Reserve will probably put on a bit of break in terms of raising interest rates. So I think eventually, whether it's 2% or 3%, the key thing is always to look into inflation numbers. The inflation numbers, if it doesn't reach a peak, I think Federal Reserve will continue to raise interest rates till there's a peak in terms of the inflation numbers. So crucial to watch whether inflation will start to moderate in the next coming months. And pretty much, if you look at commodity prices, they are the major contributor to your general rise in inflation. So really do watch out in terms of commodity prices as well, especially crude oil prices around the world. Now, I just want to point to certain indicators or certain economic indicators that's worth to pay a close attention to. One of it will be real retail sales. Now, given the fact that US is a major contributor to in terms of the retail numbers, so retail sales is always a very big contributor to the US economy. Now, if you look at real retail sales, we measures or we take into account of inflation numbers. In fact, I think the latest numbers in April shows that there's a declining retail sales growth. And if you take into account of inflation, that growth rate is actually entering into negative territory. Now, it shows you that retail sales are actually slowing. Despite if you look at absolute numbers, it's showing you growth. But if you take into account of inflation, it's actually slowing down quite gradually. Now, this is a concern. If going forward, retail sales are not showing you any sign of growth in the next few quarters, generally the economy is going to hit to a downturn. And despite what we're seeing in terms of headline numbers in GDP or some of the key other economic indicators, retail sales is always very important. So as long as retail sales are slowing down, that's actually showing you that the economy is actually starting to be quite sluggish. And do pay close attention to, because as long as retail sales are not showing you any sign of growth, I think that's where we should be paying close attention to in terms of price performance. Now, besides retail sales, if you look at other key economic indicators, another key important economic indicators is US mortgage applications. Now, if you just look at price of lumber last year, it hit a historical high late last year, despite we are seeing a lot of demand for building materials. In fact, even housing permits was actually recording tremendous growth. But in terms of mortgage application, it starts to slow down, especially in the first quarter of this year. Given for the fact that yields, especially for longer term yields, the 30 years yields are actually increasing tremendously. So consumers are facing quite a dire state. They are facing higher financing costs in terms of their mortgage costs, and therefore I think it's affecting their mortgage applications. So if you look at mortgage applications, at least for the first quarter this year, it's showing you a sign of slowing down. And naturally, when housing permits starts to slow down, when mortgage application starts to slow down, naturally will affect the whole overall economy. So retail sales slowing down and mortgage applications slowing down, that tells you that the economy is actually not on a strong footing. So going forward, it's worth paying attention to these two economic indicators. As long as it's not showing you any sign of growth, really, I think US economy is actually going to hit to quite a stagnant pace, and that's going to be a concern going forward. Now, if you look at commodities against equities, I think this year really is a theme of commodities. You just look at performance of crude oil itself. Just at the start of the COVID-19 pandemic, crude oil registered the first time in history a negative price in terms negative price, and the rally we are seeing from negative to where we are looking at $100 per barrel is indeed a tremendous rally. So if you look at it, I think if you compare performance-wise against the Dow Jones and you just take a commodity index, really can see that commodities generally has been outperforming the equity index, especially first part of this year. So going forward, you can expect a lot of fund managers are moving their asset classes or moving their fund flow, focusing more into commodity space and out of the equity space. Because as inflation starts to rise, I think commodity generally will be a better hedge as compared to the equity market. So I think that's where we are seeing a lot of underperforming in terms of the three major US indices, and that's where it's going to be a focus at least for the next couple of months. So if you break down in terms of sectors, the energy and consumer staples are generally the best performer so far this year. The rest of it has been actually quite underperforming. And the key thing is that the IT sectors, or pretty much the Nasdaq index, has been really the lead underperformer in the first quarter of this year. So it goes to show, with high valuation for some of the key major IT companies, it starts to unwind, especially when you have a high interest rate cycle. And generally, a lot of this fund flow is moving into the energy sector as a result. So I think that's a concern, especially in terms of the Nasdaq market. We have seen how the Nasdaq rallied since the start of COVID-19 pandemic. It is in fact creating a lot of high valuation in some of the key companies. And in other words, it's certain ways it's creating a bubble. So if you just look at first quarter this year, when markets expecting higher interest rate environment, a lot of funds has been unwinding their positions in, especially in the tech space, and it's moving into other sectors. So really, if you just look at the trend, whenever you have high yield environment or pretty much expecting higher interest rate environment, normally the Nasdaq will not be a favorite index itself. So really, I think the theme is actually moving. Asset classes has actually been moving out from the Nasdaq space and moving into other asset classes. Now, if you just look at Nasdaq itself, the breadth of it in terms of participating companies really is a critical point. A lot of companies that's listed on the Nasdaq exchange, some of the companies itself, in terms of the price performance, is actually showing you a 50% decline year-on-year basis. So if this trend keeps continuing at least for the next couple of months, I think technically you're looking into a technical correction in terms of Nasdaq index itself. Now, I just want to put up this chart just to show you a comparison between margin debt, which is basically margin financing for purchasing stocks, and pretty much the market performance. If you take a note that every time when margin debt starts to decline, usually it signals that pretty much the market is actually quite topish. The reason being is simple. If you just look at it, when people start to unwind their positions, whether it's to answer a particular margin call, whether to reduce their overall margin debt because the interest of financing this margin debt starts to increase, normally they will have to unwind their position in the market. And that's where whenever you see lower margin debt, normally you will expect that the market performance will also be on the decline. So that's what you're saying now. Margin debt has actually reached a peak late last year, and it's declined since then. That's where you can see S&P 500 performance. If you look at their growth, has actually been declining. So it's an important correlationship between these two important indicators, and it goes to show that as long as margin debts continue to decline, given that the higher interest rate financing costs, stock market's performance would badly be affected as well. So again, if just comparing yields, again, the Nasdaq index, you can clearly see, whenever you have a high interest rate environment, Nasdaq will not be favored, and in fact, other asset classes will normally be receiving the inflows. Now, given that this some of the key important indicators are showing you that the economy is going to head into period of sluggishness. In fact, I think generally the market will be a bit more cautious. And true enough, we just look at put call ratio, which is an important parameter to tell you how risky or how the market perceives risk going forward. In fact, the index itself actually has been spiking up at least early part of April, given the onset of the Ukraine and Russia war, and it has been staying there quite elevated for a period of time. So market going forward is actually still quite cautious in terms of risk sentiment, and really I think market generally has been quite fearful. So therefore there's a lot of volume in terms of put as compared to the call options. So as long as this put call ratio showing you or indicative of a very high level, it goes to show you that the market is actually quite cautious going forward. There will not be very much risk taking in terms of sentiment in the market. So really, I think any rally in the major US indices is actually showing you a point, or showing you an important point where a lot of these traders will be more cautious instead of taking more risk on, especially during a rally in the market. Now, besides that, if you just look at it, US terms of trade has actually been quite bad because the dollar index has actually been strengthening aggressively, given the expectation that interest rate will continue to hike. So really, there's a lot of carry trade going on, and in fact, I think dollar index has actually breached the 100 mark. So I think going forward, really, whenever you have a strong dollar, it doesn't bode well for the equities market. Historically, it has been that pattern. So as long as dollar continue to strengthen, the equity index will always be pressured, and that's where we also need to be aware of whenever you're looking at the dollar's relationship against the equities market. Now, coming back to sentiment wise, like I mentioned earlier, I think generally, market has actually been quite fearful. There's a lot of risk off if you look at sentiment wise.
And you just look at sentiment survey, which is conducted on a weekly basis. I think just last week, in the last week of April, it was registered, I think, one of most bearish sentiments since the start of the COVID-19 pandemic. We have not seen those numbers since the start of the pandemic itself. So really, it goes to show, I think, market is actually quite fearful to a certain extent. And really, I think any rally in the market, traders will actually be unwinding their positions rather than taking on more positions. So these surveys are conducted on a weekly basis, and it's important for you to track it, whether sentiments are still going to be that rosy as we enter into the next couple of months. So now, in terms of price performance, I shown you earlier, I think across the 3 major US indices, it's trading way below the 200 period EMA. If you just look at the Micro E-mini Dow, prices itself is actually moving on a sideways pattern, but of late, I think prices has been trading below the 200 period EMA. Now, the 200 period EMA is important in the sense that it tells you the overall gauge of the market, and it's actually been moving on a sideways basis. That means the market has actually been trading on a sideways range for quite a period of time. Now, as prices continue to trade below the 200 period EMA, it does tells you that generally the trend on the market is still quite bearish. And if you just take a resistance based on the 200 period EMA, the resistance is still pretty much quite strong at about 34,000. And obviously, any breach above that may indicate that the market may try for another price rally. But if it continues to stay that below 34,000, and that shows you that there's a lot of weakness in the market. Now, I'm just showing you 2 exhibits here, basically on the different is based on the same product, but putting in on a different indicator. So if you just look at it, whenever you are doing trend trading or whether you are looking into charts, if you're a trend trader, you always want to be in a trend whenever the market is trending. So obviously, if you just look at candlesticks itself, Japanese candlesticks, which is very common, is available on most of the platform. So it's very difficult for you to be staying on a trend throughout the whole time because there's a lot of whipsaws. And if you just look at these 2 exhibits which I've shown, and if you just look at it, which exhibit would tell you that the trend is depicted in a clearer manner. So obviously it's exhibit B. Now these are same product and on the same time scale. The only difference is that exhibit A is actually based on Japanese candlesticks and exhibit B is based on Heiken Ashi. Now Heiken Ashi is a derivation of Japanese candlesticks. It's just taking the average bar of Japanese candlesticks. Now, reason being to use Heiken Ashi as compared to Japanese candlestick is because Heiken Ashi can show you the trend of the strength of the trend in a much clearer manner as compared to candlesticks. And whenever you trade using Heiken Ashi, it's a much simpler form compared to using Japanese candlesticks, because Japanese candlesticks has a lot of variation and there's a lot of pattern that you need to be aware of whenever you're trading using the Japanese candlesticks. So I think in most of my trading setups, I always base whenever you look at trend trading to use Heiken Ashi as compared to Japanese candlesticks, because whenever you use Heiken Ashi, it's actually quite simple. There's only 3 simple patterns that you need to be aware of. Whenever you see a red colored body bar, normally tells you the trend is bearish. Green colored body bar normally tells you the trend is bullish. You just have to be, if you see wicks on both ends, normally tells you the strength of the trend is weakening. If you don't see wicks on both ends and wicks on a single side, that tells you that normally the trend is going to be, the momentum is still there. And if you see a doji type of style, normally tells you that the market is probably moving on a sideways. So with these 3 basic trend, it can depict whether the existing trend is still in place. As compared to Japanese candlestick, there's so many variation. You have to be mindful whether there's a particular setup based on a different configuration. So Heiken Ashi simplify it into 3 simple patterns that you need to be aware of, and in certain extent you can be staying longer in the trend,
and you can pretty much stay across the trend throughout the whole duration of it. So this will give you a dynamics of it. So if you look at it, every time when you see a red bodied Heiken Ashi bars, that tells you that the market is actually on a bearish mode. If you look at, there's always a series of green and red candles in Heiken Ashi, that tells you that actually the market is moving on a sideways pattern. And when you see a big momentum, when the colored body bars are getting bigger, the bodies are getting wider, bigger, longer, that tells you that the strength of the momentum is there. So normally it tells you, generally the market, if you see a red colored body bar, that tells you the market generally has been quite bearish. Now, with Heiken Ashi, if you incorporate moving averages as to determine your entry and exit, you probably will add another filter criteria, so that at least you won't get too many whipsaws if you just look at Heiken Ashi on its own. So if you incorporate moving averages as part of Heiken Ashi, it does give you a better signal in terms of when to entry and when to exit your position. So what I have here is that to do a two type of moving averages crossovers using the exponential moving average, but two different time period. One is using a shorter term time period, which is a 9-period EMA, and another one is using a longer term time period, which is a 20-period EMA. So whenever you have a bearish crossovers, it indicate that generally the shorter term is crossing below the longer term period EMA. Generally that's a bearish crossover. So the signal comes especially when you look at a Heiken Ashi bar. If it's a red color Heiken Ashi bar and you have a bearish moving average crossovers, that tells you the market generally is going to be on a downtrend. Vice versa, if you look at whenever you see a bullish crossovers, especially when the shorter term crossing above the longer term, and you look at a green Heiken Ashi bars, that tells you that generally the market it will be a good entry for you to be entering a long position. Again, just to put it in context into a different market, this is basically an example of a Micro E-mini S&P. Again, the same principle applies. If you have a bearish crossovers, if you see a red Heiken Ashi bars, that tells you the market generally is going to be on a downtrend. So that will be a good entry point for you to be shorting the market. So you can hold until the particular trend until where you see a sideways pattern on a Heiken Ashi, or when you see moving averages starts to turn, that could be a very good position for you to be exiting your short position. So in a sense that if you incorporate Heiken Ashi together with moving averages, it gives you a better signal as to when you can entry and when you can enter, as well as when can you exit that particular position. Another example, this is basically on Micro E-mini S&P on a bullish scenario. So again, you can clearly see there's a bullish crossover, which means that the shorter term crossing above the longer term moving averages. And you can see a green Heiken Ashi bars, that tells you generally the market is going to be heading on an uptrend. So you can hold on to that trend position until when you see a red Heiken Ashi bar, which is trading way breaking down your moving averages. That could be a signal for you to exit that particular position. So not only moving averages shows you where a particular point for you to enter and exit, it also provides you a level of where generally the prices will be trading above the moving averages lines. So in other words, the moving averages also provide you the support and resistance line for each of the candle bars. So same vice versa, if you see red Heiken Ashis and bearish crossovers, generally the market is actually on a downtrend. So I think last, whenever you have a trading plan, it's always important for you to incorporate risk management. I think one of great tool whenever you want to use for risk management setup is to use a technical tool called average true range. I'm not going to go too in depth on the calculation of it, but basically true range is basically taking the differences between today high and low against yesterday close, and whichever is greater. So it shows you the depth of the volatility in the market. And during period like this, where you can see like Dow Jones, you can easily see 200-300 point movement on a single day or intraday basis. ATR is equally very important because if you manage your risk, in a very volatile market, ATR is very critical. You have to make sure that if you set too tight of a stop loss, you don't get stop up easily. But you also don't set too high of a ATR too high of a stop loss value where eventually you will burn your account. So I think ATR is a very good measurement in terms of risk management, in the sense that it does reflect the volatility of the market whenever you're positioning your stop losses. So to give you a general view on how to use ATR, I think whenever ATR value starts to expand, or when you see high ATR value, normally indicates that the volatility in the market is actually increased. And normally high ATR value will result, whether it's advancing market or declining market, it doesn't really matter. High ATR value just tells you that the volatility on an intraday basis has actually increased. So therefore, make sure that you put your stop loss in place, according to ATR value. Now, low ATR value usually accompanies when the market is going on a sideways. Normally, the range of the intraday basis is actually very tight. This usually happens when the market is actually consolidating. There's no exactly trend in the market, whether it's going an uptrend or downtrend. Normally, in the sideways market, you usually accompany on the low ATR value. So low ATR value, again, you can measure your stop loss measure according to the ATR value. And I think it's useful in the sense that during a sideways market, if you set too tight of a stop loss, normally you get stopped out quite often. So if you measure according to ATR value, it does help to a certain extent, and it does make sure that you don't get stopped up too often. Now, a common tool whenever you use ATR is to use a multiple. Again, I think there's no fixed multiple as to how you can fix your ATR value. Some may use 2 times of ATR, some may use 3 times of ATR. It all depends on your risk preference and your risk tolerance. So if you are someone that cannot tolerate too much of a risk, you may use a lower multiple. But if you are someone that can tolerate a higher amount of risk, then you use a higher multiple. So every time when we want to set a stop loss or even a target profit, we always be calculating in terms of multiple of the ATR. General rule of thumb, two multiple of ATR is a very good gauge. So say for example, if you have ATR value, your target profit will be 2 multiples of ATR, so it will be 2 times of your ATR value, and your stop loss will be just the ATR value. So to give you an example, if you just look at Micro E-mini Dow, at least since the start of 2020, you just look at, I think during the COVID-19 pandemic, we saw the biggest spike in history, the intraday volatility. I think it went as high as 2,000 points on an intraday basis. That's huge. And obviously, I think first quarter of this year, we have seen rising volatility as well. So really, I think we're entering a period of high volatility. So as a trader, you tend to love volatility, but really, you just have to make sure that stop loss must be in place to capture this kind of volatility. Because if you don't get stopped up too often, because the range has actually widened, and again, you also don't want to put too high of a stop loss value where you can eventually burn your account. So I think that's where a fine balance will have to be balanced with, and I think ATR is a great tool for you to be using, especially when you want to set your stop losses. So I think one of the ways is that to use ATR to put it as a stop loss level. So just an example on a Micro E-mini S&P. So the ATR value on an intraday basis here is about 16 points. So if you use a 2 times multiple of ATR, so say for example, there's a very good entry in terms of a setup here, which is you can see a bullish crossovers as well as a green Heiken Ashi candles. That's a very good entry, good setup for taking a long position. And if you just look at ATR value, is about 16. So that means you should be putting your target profit 2 times of ATR, which is about 32 points, and the stop loss level at 16 points. So that's how we use ATR as a way to measure or to gauge your target profit level as well as your stop loss level. Again, I think another example of using ATR on a Micro E-mini Dow. So what you have here is a classic example of a short setup. As you can see, a bearish crossovers on moving average accompanied by red Heiken Ashi bars. So that tells you that the market generally is going to be a downtrend. So you'll be entering about 35,000, assuming that intraday ATR value is 80 points. So you'll be setting up 2 times of ATR value, which is 160 points, and a stop loss level at ATR value, which is 80 points. So that's how you manage your stop loss level. Again, the multiples are pretty much depending on your risk tolerance. If you're someone that can tolerate higher risk, then you use a higher multiple. If you're someone that is not able to tolerate higher risk, then you have to use a lower multiple value based on your ATR value at the end of the day. Coming to a trading plan, I think just to put in summary, first thing I think it's important for us to establish a trend. Generally, if you're a trend trader, generally you just want to be trading with the trend. Trading against the trend is very difficult, especially during this time where you tend to get stop out easily. So one way to determine the trend is to use a 200 period EMA. That's for the longer term trend. If you want to go into the shorter term trend, you'll be using a shorter term period. Normally the market gauge will be using at a 200 period EMA. So if your prices are trading below 200 period EMA, that tells you the market generally is quite bearish. If it's the prices are trading above it, that tells you the market generally has been quite bullish. Now, if you want to look at shorter term trend, you can always use Heiken Ashi candles instead of Japanese candlesticks, because Heiken Ashi candles is actually taking the average of Japanese candlesticks, in a sense that it does depict the trend in a clearer manner. So in other words, you'll be staying in the trend longer, keeping your position longer as you compare to Japanese candlestick. Now, one of the disadvantages of using Heiken Ashi is that it doesn't include the gaps. If you just look at Heiken Ashi and you look at Japanese candlesticks shows you the gap, but Heiken Ashi doesn't. So if you're a gap trader, I think you find it very difficult to use Heiken Ashi as a way for you to trade. Now, if you incorporate EMAs, crossovers as part of, if you incorporate EMAs together with Heiken Ashi, it gives you a very good entry and exit signals. So I just highlighted some of the key examples where you can actually use it for you to enter and exit accordingly. Last but not least, I think it's always important for you to utilize ATR values in terms of multiples as a way for you to set your target profit as your stop loss level. So I think among the products I mentioned earlier, I touched on Micro E-mini Dow and Micro E-mini S&P. So micro contracts are, in terms of the margin itself, is actually very relatable, and in a sense that you can definitely be sizing up positions accordingly, and in a way you can manage your risk in a much better and efficient manner because of the size of the contract. It's 1/10 of your mini contracts, so it gives you a lot of greater flexibility in terms of managing a risk. Now, in terms of volume wise, if you look at CME contracts itself, really I think it has been growing in terms of the micro contracts itself easily for the past 1 year or so. In fact, I think it hit a billion contract just early part of this year. So really, I think there's no issue of finding it difficulty for you to be exiting a position with a cost, because there's a lot of liquidity in the market, and margins for this are very small. In fact, it's very easy for someone to begin their journey, especially on trading US indices with the micro contracts. So I think I'm just going to end here with a quote. So if you have, I'm not sure any of you have read this book by Steve Watt. It's called Bulletproof Trader. Now, I think the journey of trading is always a difficult journey in the beginning. Reason being because it's not about technique at the end of the day. It's really about the process, the mental capital, the mental agility whenever you're dealing with a market like this. Market conditions like what you're facing now, a lot of volatility in the market. It's going to be a very difficult proposition to a lot of young traders or traders who are wanted to start their journey in this market. But if you have the time, do check out this book by Steve Watt. I think it mentioned a lot, it touched a lot on processes, which I think is vital for any trader. And I just want to share a particular quote from the book. He mentions, what is your process for dealing with difficult trading situations? I think many traders give a lot of thought to the process of finding opportunities in the market. That's where a lot of traders are attuned to finding the best entry, the best trading signals, or any of the best technique that's available in the market. But rather, I think there's little emphasis on actually process of dealing with how the psychology of the market, or in fact, dealing with challenging market and trading situations. So psychology plays a very big role whenever it comes to trading.
and I think it should be given more emphasis for someone that's going to start the journey in terms of trading. So do check out the book if you have the time. I think it's available on some of the key major websites. So do check it out. I think with that, I'm just going to end here for any Q&A from audience. So back to you, Sri.
Thank you so much, David. And there you heard it from the proprietary trader himself. Bulletproof Trader is highly recommended. Okay, we're going to wait for some questions from the members of the audience. You just head to your control panel. Somewhere at the bottom, you should have a questions panel. Just type your questions in there and we'll address them in the webinar. In the meantime, David, what do you think are the three key points based on what you have covered today that members of the audience should take back and act on it, or what are key three takeaways for the members of the audience?
Okay, thank you for the question. I think the first point is, be very wary of the market developments going forward in terms of fundamental, whether it's Federal Reserve policies or whether it's just basic economic indicators. I think that's all pointing to a situation where market is actually going to slow down eventually. I think secondly is that volatility is rising. Clearly you see the ATR value for most major US indices is actually rising quite rapidly. So it indicates that if you are, as a trader, you love volatility, but without a proper risk management in place, you tend to get stopped out, or you probably be putting yourself in a very too much of a risk. So always make sure there are proper risk management in place. I think thirdly is we just have to be very sensitive to our positions, regardless what kind of market conditions we are in. Having said that, I think keeping a plan and always be disciplined in following your particular setups, and I think that's eventually will be something that as a trader you have to be mindful of, regardless whether win or loss the result is. Always make sure that you're diligently following your processes and your trading setups, because at the end of the day, regardless of the market conditions being volatile as it is, if you're following your setups, eventually you will get it. You get where your result is going to be.
Hey David, okay, we have a question from a member of the audience. He's EG. EG is asking, can you repeat what EMA periods to use for Heiken Ashi?
Okay, the EMA periods that are used generally in the examples I given earlier is basically two type of periods. The one shorter time period is basically a 9-period EMA. The longer term time period is a 20-period EMA. So it's 9 and 20. And Heiken Ashi is you incorporate your Heiken Ashi, the same principle. Whenever you see green Heiken Ashi candles, and if you see a bullish crossovers on EMAs, that normally generally be a buy signal, and vice versa.
David, all right, next question is from Gary. Gary is asking, is there a major crisis coming soon? And what is the impact to the global market? And should we still be looking at US indices when that happens?
Oh, that's a very good question. Now, it's very difficult to call a crisis, whether it's going to be very soon or in time to come. But what really you're seeing now, what we are witnessing now in the market, is that we are slowly seeing central bank unwinding their policy that have been so accommodative for the past decade, since the onset of the global financial crisis. When things starts to unwind, generally, there will be a lot of volatility in the market, and that's where we need to be accustomed to. Now, I share with you in terms of the economic fundamentals, there's certain things that we just have to be putting a bit more emphasis, whether I mean, going down the road, whether those signs are showing you a bit more sluggishness, I think that's where it should be the immediate concern. A crisis is still too early to tell. I think generally, like I mentioned, Federal Reserve will just have to be very mindful of hiking the interest rate cycle aggressively. But eventually, if the market starts to, the fundamentals starts to decline, I think generally Federal Reserve just put a break, and in fact maybe they'll go back into easing the policy back again. So generally the market will be well supported. Calling a crisis is really a difficult proposition. But really, I think in terms generally the market is going to head into a period where we start to see sluggishness. May not be only in US. It's not limited to US only. It's going to be across the world. So as whether you are trading a market or whether you're an investor in the market, I think that's where you need to embrace going forward.
All right, thank you so much, David. And that's all the time that we have today. If you have more questions, please type them into the survey form that we have at the end of the webinar. And we will get David to look into your queries and we'll respond via our follow-up email tomorrow. All right, I hope you have enjoyed the session. Till our next live webinar, please take care and all the best in your trading. All right, thank you, David.
Thank you, Sri.